Welcome to the deep dive. So today we're digging into something kind of tricky. This investing app, Alinea. It looks really friendly, marketed heavy towards Gen Z, towards women, promising easy access. But there's this buzz about a pretty hefty fee, like $120, maybe hitting you before you even really start.
Exactly. And that's the core tension we're looking at, this promise of being open and accessible versus, well, what users are actually experiencing with things like that big annual fee. So our mission is to unpack that, look at the structure, the regulations it follows, and then weigh that against these kind of alarming user complaints.
Okay, let's start with the structure then, because, on paper, it seems to tick the right boxes. They talk about fractional shares, which is great for beginners, expert-built portfolios, even crypto access via Alpaca, and importantly, they are an SEC-registered investment advisor.
Right. And that's the structural legitimacy piece. They also use Drive Wealth for the actual brokerage side of things. Drive Wealth is a known entity, and that partnership means accounts are SIPC insured.
SIPC insured, okay. But maybe we should clarify what that actually means for you listening.
Good point. SIPC insurance protects you if the brokerage firm itself fails, like goes bankrupt. It's not insurance against losing money in the market, and crucially, it doesn't protect you from, say, high fees or bad service.
That's key. So they have this sort of official shield, SEC registration, SIPC. It looks solid, but that registration doesn't mean the business practices are necessarily fair or good value, right?
Precisely. The paperwork can be perfect, but the user experience can be, well, something else entirely. And that's where we see a disconnect. You look at user reviews, like on Trustpilot. The score is low, really low, like 2.5 out of 5.
Wow, okay. And what are people actually saying? Is it just market complaints?
No, not really. It's much more focused on the platform itself.
Yeah.
The big one is that $120 annual fee we mentioned. People report getting charged sometimes before they've even funded the account or properly started using it.
That feels predatory, especially if you're targeting beginners who might only invest small amounts initially.
Exactly. Think about it. If you, as a beginner, put in maybe $500 to test the waters, that $120 fee is instantly a 24% loss before you make a single trade. It essentially guarantees that small balances, the kind beginners often start with, are likely to be significantly eroded, if not wiped out, just by the fee structure.
So the value proposition seems weak just based on the cost alone.
Very weak. And it gets potentially worse. We're seeing reports about poor customer support messages ignored, that kind of thing. And maybe the most worrying point, some users claim they were blocked from withdrawing all their money. Like, only allowed to take out half.
Wait, hang on. If they're SEC registered and using Drive Wealth, how can that happen? How can they limit withdrawals like that? Isn't that what regulation is supposed to prevent?
That's a really important question. It highlights the difference between, let's say, structural legitimacy and functional friction. Yes, they have the SEC registration, the partnership. That's the baseline structure. But these reported behaviors, the high fees, the poor support, the difficulty accessing your own money, that puts them in what some analyses call the classic red zone. It's creating deliberate friction. Even if the structure is technically sound, if you can't get support of your money easily, it becomes functionally risky and unreliable, especially if you're new to investing.
So it sounds like the source's conclusion is kind of blunt, but maybe accurate, legit, but predatory.
I think that sums it up well. Structurally, it exists within the regulatory framework, SEC, SIPC, Drive Wealth Partner, check, check, check. But the behavioral pattern, the high hidden fees, the reported friction, the poor service, suggests a model that isn't really designed for the user's benefit, especially not beginners. It's just weak value compared to so many other options.
Okay, so the big takeaway here for you listening is pretty stark, isn't it? Just because an app is SEC registered or SIPC insured doesn't automatically mean it's a good choice or even a fair one.
Absolutely. Those things provide a minimum safety net for certain catastrophic failures, but they don't guarantee a good user experience, fair pricing, or helpful service. They allow the app to operate legally, but don't stop it from being potentially a really bad deal for you.
Right, and when you think about it, there are so many established platforms out there, big names offering very similar features, fractional shares, ETFs, sometimes even crypto, many with zero annual fees and long track records. It makes you question the opportunity cost here.
It really does. Paying $120 upfront just for access when free, reputable alternatives exist, it's a high price.
So maybe the final thought to leave you with is this. In the world of finance apps promising ease and convenience, when does that convenience actually become a hidden penalty? Maybe a penalty targeted specifically at inexperience.